Okay, so I'm gonna now allow you to be the host. So I'm gonna say make host. So now you can share your screen.
All right. Let's see. More. Share. Share screen.
Okay, perfect. Okay. Okay. So let's see. How do you go to your virtual account?
Mm,
Let's see.
I don't even know if it has that. Does it?
Okay, hold on. Um,
Something?
Click on view all E-Trade brokerage position. Okay, so that's what you currently have right now. So you have a custodian account and you have an individual brokerage account. Okay. Scroll down a little. Oh, you got a Roth IRA, you have an individual brokerage account. Okay, go up a little bit. Okay, you see where it says there's a gear after underneath more impact. Um, Hit cancel. Oh, you can't switch to options, can you? Which is next to the gear on the left. Let me see.
Maybe because I don't have any options right now.
Okay, you don't. Okay. Um, yeah, you should be able to do option trading. Huh.
I can do options trading, but I'm saying that
Okay.
that list.
Okay. Yeah. Yeah. Click on option up top.
Mhm.
Okay. Perfect. Okay. So then now change out SPY for let's say SPX. Click on that the first one. Okay. So now the SPX is which is the Dow Jones, the top 500 companies in the U.S. So
Mhm.
this is the stock market. Now, when you're trading, okay, what are some of your favorite companies that you like? Let me ask you that way.
Uh, I guess Apple.
Okay, Apple,
Mm,
any other companies?
I heard somebody saying that they were successful with. I'm not 100% sure what strategy you're doing, but she said she was collecting with Riot, RIOT.
Okay, you go to Riot. So take out SPX and go to Riot, RIOT. Yes. Okay, they deal more like with if I remember correct, bitcoins and stuff like that.
Mm,
If I remember. Okay, so now it says 1704. So now click on options because you got overview chart options. Good. Now, you said you traded options before because you've done naked calls, naked puts.
yes.
Okay. I also love naked calls and naked puts myself, but it is capital. It requires a little bit more capital than say credit spreads. You've never traded credit spreads before?
No, no, I have not.
Okay. So basically, credit spreads is just basically a variation of the naked call, naked put.
Mhm.
It's just instead of just having a sold position, you also have a bought position. So let's take instead of February 27th, let's look at what's the third Friday in March? That would be March 20th. So click on that March 20th. Okay, good. So here's how a credit spread works. So let's say you like you want to buy. Riot, but right now it's at 1703. Let's say you only got $1,000. Let's just say to trade.
Hmm.
Well, you could click on the bid price at the $10 strike, collecting $1.05 on the put side.
$10 strike.
Yes.
Okay, $10 strike, and on the
I mean,
put.
not $10. Oh, okay. Oh, they're only giving you 8 cents. Sorry. I misread. I misread. Okay. So then here's what you're going to have to do then. Okay. Because you're doing credit spreads. So it's not the $10 strike. Sorry. The $16 strike.
Okay, the bid one you said.
Click on the bid there. And then you got to say trade options, which is kind of annoying. Okay. You're going to do a sell to open. Okay. Now you're also going to have to do a credit spread. We're going to go, let's say $5 wide. So let's say instead of 16, 15, $11, go to the $11 strike.
Mm-hmm.
And then you're going to click on the ask, which is around at 14 cents.
Okay.
You're going to buy to open.
Mm-hmm.
Okay. This is a credit spread. So what this does is notice, so your net bid is like 91 cents. So you'll make 91. If this trade went through, you would make $91.
Uh-huh.
Okay. But so so you bring in $91. However, you're only now risking the difference between the strike prices. So they're $5 wide
Mm-hmm.
minus the 91 cents that you're collecting. So you'll have what, $4 and 90, let me give you 91, and $4 and like what, 10, 11 cents is your risk.
$4. So that's isn't that $400?
Yes, $400 of risk. Yes,
Oh my gosh.
to
Okay.
make $91.
Okay.
Now
Uh-huh.
you would say, now, well, why would you do that? Well, see, unfortunately,
Mm-hmm.
we don't see the deltas on here, but what we're looking at is what is called the probabilities. Or let me see, do we see delta? No, we don't see delta. We see volume, open interest.
Should be able to
You got the bid and the ask.
add it.
Yeah, you can add that.
Let me see. Oh, I was just trying to see if I could get it added. Hmm. That's weird. It should give you because I thought we had a gear wheel before, didn't we?
We did. Click on viewer. There we go. Hold on. Let me see. Options. No, let me see. No, go. No, no, no. We don't need a chart. Options. Give me a second.
Mm-hmm.
Okay. Go to setting. No, that's earnings. Sorry. I misread that. Okay. Hmm.
That's weird though. That is
We just saw the year. Give me a second. Go up. Then I set alert. No, we don't want that. Okay, what I'm going to do is take back control, and I want you to see it from my screen.
okay.
So this way,
As you're doing that, so far it's you're looking for the third week, the third Friday, and then a $5. But how did you get to the six? Like we're at 17. How did you get to 16?
hold on, give me 1 second.
Okay then.
Okay, hello.
Yeah, let me go back to Zoom.
Okay, you should be able to see my screen.
It's populating. Okay, yeah. Tasty trade. Uh,
Yeah,
okay, gotcha.
they don't offer a virtual account, so unfortunately,
Hmm.
so I have to trade in my real account. Um, okay, so let's say I want to do a credit spread. So let's say on Riot, I'm going to go to Riot,
Mm-hmm.
RIOT, and I'm going to click on trade. Now they got earnings coming out on March 2nd, but I don't care about that. Actually, no, I do care about that. So we're going to do March 20th, which is the third Friday in March. Now, because of earnings, that means this stock, we don't know how the stock is going to respond off of earnings, and that's the problem with that. But
Yeah.
let's say I want to make some money off of Riot, but I don't have to. Let's assume I don't have the capital. Now, actually, I do. But if I was to do, like, let's say, a naked put, I could do a naked put at, let's say, I don't mind owning the shares at $14, but then I will collect $46, but I have to put up $1,300 of buying power.
Mm.
Okay. Now, if I pull up a calculator,
Mm-hmm.
right? Let me see what my return would be in 20 days. So 46 is the profit. Oop, divided by 1354. So I'm looking at about a 3% return, which is fine. In 20 days, that's not bad,
Mm-hmm.
right? But that's a naked put or a cash secured put because I have the capital. So it's considered cash secured. Naked just means you don't really have the capital to execute to get the shares if you put it to shares. That's all that means.
Gotcha, gotcha.
Okay. But cash secured means you got the capital. I happen to have the capital to take hold of the shares if I wanted to. But I still would not do this trade for this reason. Even though it's a nice 3% return, but I'm only collecting $47, but I got to put up almost $1,400 of risk to do so.
Right.
So what is a more capital efficient way to get almost, I won't collect as much, but reduce my buying power, which would actually increase my returns.
Mm-hmm.
So like I can go 5 points wide. So 14, so five would be what? 9. Okay.
Mm-hmm.
Now I'm going to collect $41, but look how much is my buying power. $459 of buying power rather than almost $1,400 just to collect what, $6, $7 more.
Right.
You see, this is what a credit spread is. So then now, if I look at my returns, $41 divided by 459. Now I'm looking at a 9% return.
Mm-hmm.
You understand? That's the beautiful thing about credit spreads.
Okay. So what move for you to get the $41, what movement would the stock need to do?
Just stay above. Well, you get the $41, it immediately comes into your account. So you can do whatever you want with that money.
Uh-huh.
That's the beautiful thing about it. Now, to keep all $41 and not have to spend anything back to buy back the stock or to get the stock, all you need is the stock to stay above 14.
Really?
Yeah,
Now that works in a bull market.
yeah. Now, the reason why I don't like this particular trade is because of, especially if you're new, is
Mhm.
earnings. It's coming out on March 2nd.
That's the uncertain.
That
Extra.
you don't know how this stock is going to respond.
Right.
Especially this is not considered a
Hmm.
one of the big boys like
Hmm.
Microsoft, Apple, Google, and those type of companies. I mean, these people they deal with what Bitcoins and stuff like that.
Yeah.
So this stock could fall down
Mm.
to a thousand or $10 or $9. It can go down there
Okay. So if
off of earnings.
we just want to avoid earnings because of the uncertainty, and then
When you're new, yes, that's the first thing I always recommend.
Mhm.
Avoid earnings.
Okay, that makes.
So I would not do this trade for. I mean, personally, I would not even do this trade, and
Mhm.
I got experience
Because of earnings, or is
because of
that,
because of the earning.
okay? Makes sense. That makes
When you're
sense.
doing credit spreads, unless you don't mind owning the stock, and I've traded Riot before, so I'm gonna be honest with you,
Hmm.
and I don't mind owning the stock. So in actuality, now that I think about it, I would do that trade
Mm.
because I have experience. So I would know what to do, if it should drop off of the earnings. But I'd rather trade other companies like let's look at Apple, because I don't own any Apple shares. See, if you look, these are some of the symbols that I own. This /ES, this is the S&P 500 futures, because
Hmm.
I do trade futures. This /GC is the gold futures. This /MES, this is the micro futures of the 500. So this here allows me to trade naked puts and naked calls. See, I collected $117, and this trade expires tomorrow, by the way.
Mm.
Yeah. Steve, matter of fact, let me just show you what I did because I actually put this trade on today. So I have this trade and it expires tomorrow, but
Hmm.
I did a naked put at 29. I mean at 69.05. So I have a 20. There's now see this is why I like the delta, because the delta tells you a lot. The
Hmm.
delta tells you two things. Number one, for $1 move in the stock, how much will your option move? Well, for $1 move, so let's say this MES moves down $1, that means this option moves 29 cents in theory.
Right.
Okay. But the major thing to look at is not really how much it moves per dollar, but what is the probabilities? Because we trade on probabilities. I trade on probabilities. That's
Right.
how casinos make their money. Well, what is the probability that MES will get to 69.05 by tomorrow? So this telling you that this has a 29% chance of it getting to 69.05, which means if you subtract it from 100,
Hmm.
that's like what, 81%? Or 70, I'm 71%, 71%.
Hmm.
71% chance that I'm going to make at least $1 or a dime off this trade. That's all that's saying
Gotcha.
on the downside. Now, I also did a trade on the upside. This is called a short strangle, by the way. That's, a naked call. Here is a 19% chance that MES goes up to 7,000. So you can't lose on both the up and downside. Think of it like an elevator. The elevator has to go up, but it can't go up and down at the same time. It can't do
Right.
both.
Right. Right. Right.
So I'm either going to make money on the downside, or I'm going to make money on the upside, or I'm going to make money on both sides. It's going to be one of the two.
Hmm.
So that's what I'm doing. But let's look at Apple though. So because your account is small, this is the area that you should be trading in is really credit spreads
Credit spreads. Okay. Yeah.
because it requires less capital.
Okay.
See, and since there's no earnings coming up in the next 23 days, March 20th, see, a company like Apple would be a good opportunity. So when I think the best thing to do on credit spreads is go to, like, let's say a 10 delta. So you sell the 10. Let's see, we do 5 points wide. So 47.50. So that would be 40, huh?
42.50.
Yeah, 42.50 right here.
Mm.
Now, yeah, you're collecting, like, say, $31, $29, but with $471 of risk. So now let's see what that return would be.
But how often do you place a trade though? Is it once a month?
No, but because you're new, if you're new to trading, I always tell people go out at least a month to start. But
Mm.
I actually do weeklies or even dailies.
With the same like five.
Yes.
Interesting. Okay.
But when you're new, it's
Mhm.
best to start off doing a month because you want to start off making money and being profitable, seeing how things work.
Right.
And then you can gradually decide, well, you know what? Instead of waiting up almost a month to make money, I can do it in a week or even a day. So this is a 6% return. But what if I say, okay, I'm going to take advantage of both sides. So I could also do the call side, and this would not increase my buying power. So I go up to about a 10 delta on the call side. So 295 and then 300. So that's 5 points wide. Now look, now instead of collecting just $30, I collect $65 on the same $437 of buying power. But look at this thing called pop right over here. 80%. That means that you got an 80% chance of making at least a dollar. That's all that means. You got an
What is
80%
this?
chance of making money.
What is this setup called now? Because the first one you showed me was a credit spread. What is this one called?
This is another credit spread, but this is a bull put spread and a bear call spread. It's really called
Mhm.
an iron condor.
An iron condor. Okay.
Yes,
Gotcha.
that's what this is. And I trade this often.
Yeah. Like this is
Yes.
your daily go to.
Yes, but I don't do it on Apple. I'm gonna show you what I do it on though.
Okay.
Divided by 436. So that you get a 15% return if this trade expires worthless. So 15% in less than a month, 23 days, that's pretty good.
That is good.
However, when I do credit spreads and do this trade, I don't do it on Apple because here's why. Apple, what if news came out tomorrow that Steve Jobs passed away? Not Steve Jobs, I'm sorry. Tim Cook passed away. What do you think happens to Apple stock?
Oh, it's gonna take a hit.
Go take a hit. What happens if you find out, oh, Apple fudged its numbers?
Oh yeah, that's gonna tank.
See,
Yeah.
exactly. So
Yeah.
I don't do it on, I mean, I do it on particular stocks, but I'm not doing it on Apple because this is an okay return, but I feel like I can do better. So, but here is what I do it on SPX. So on the SPX, I'm trading the index, which is the
Mhm.
S&P 500 index.
Right.
Now, the beautiful thing about the trading the indexes or the ETF is running out of time. Okay. The beautiful thing about trading the index or the ETF is you don't have to worry about if the CEO dies or they're fudging in numbers because these are the top 500 companies.
Right. Right. Right.
So let's say on that same March 20th, okay, I got to be quick because I'm running out of time. I can go further out on the same expiration, go to a 10 delta, I'm giving myself room to be wrong in case the market moves against me. And let's say I'm going to do a 5 points wide. See, so for the same risk, I'm much further out. And look at my probability of profit, 95%.
Mm.
But what if I do the call side as well?
So this is how far out you go for your daily trades?
Um, yes, 10. I always go out to at least a 10 delta.
No, I mean, expiration wise, you took.
Oh no. Expiration wise, I'll either do a daily or weekly, or if I do a monthly, I go out to like 22, 30 days, or even a little further out. So, but let's say you did a 10 delta, you do the same $5 wide spread.
Mhm.
Now, here, look, now you only make, I mean, you only have a 73% chance of making money, which is a little less than the 80% chance from Apple. But look, you actually collect more money, $80.
Mm.
And then if you look at let's take it from the table to the curve, this is what it looks like. This is where the stock is at. So as long, look at all this green. As long as it stays in the green, you're making money.
Gotcha.
See? So you're giving this index room or this stock room to go up and down. See, I don't care where it goes. I just say, where's it not going to go?
Right, right. Okay.
Now, later on today, like at around 3:45, 3:30, 3:45, what I'm going to do is this. Give me a second. Let me go back. And I didn't mean to do that trade. Okay. Oh, go back to table. Let me clear this. This is called expiration. So zero D DTE or zero day. That means this
Today.
expires today, but I
Mm-hmm.
don't want to do today, so but I can do for tomorrow. So
Mm-hmm.
around 3:40, 3:30, 3:45, this is what I plan on doing. The same exact trade that I just showed you, but going down to a 10 delta.
Mm-hmm.
But now what I do is I don't do 5 points wide. I usually do it like a 10 or 20 points wide. That's me. And then here on the upside, I'll wait and do it this way. See, collect at least now. See? So I'll collect $160, around $160. I got an 83% chance of making money,
Mm-hmm.
but I'm putting up about $1,800 of risk.
Gotcha.
Okay, now let me see what this return is for one day.
A little under 10%.
Yeah, 9%. So
Mm-hmm.
you're right. So a 9% return in one day, and if I click on curve, see, as long as it stays in the green, I will be making money. Now, what I'm going to now see, here's the key with this type of trade, though. So let's say I do collect $160,
Mm-hmm.
right? The goal when you're doing credit spreads, especially when you're doing on the index, which is the S&P 500, SPX, this is the index. The goal is not to keep $160. If I get at least 50% of that, so that would be at least what, 85, $90.
Mm-hmm.
If I get half of that, I close out the trade.
Really?
Yes. Here's why.
Mm-hmm.
Because the longer you're in a trade, the more risk you have. And
Mm.
so isn't it better to make how long you been in Dwayne's group, in the Rich Dad group?
Oh boy. 6 years or so.
Okay, so you've heard him make this statement. 5% of something is better than 100% of nothing.
Exactly. That's so true.
Okay. So 50% of something is better than 100% of nothing.
I see. I see. That's where your discipline comes in.
Yes,
Yeah,
because
yeah.
when I'm doing credit spreads on the index, see, I cannot afford to own the index. So, like in other words, if I decided to get rid of, let's say I'm going to get rid of this leg and this leg. Let's say I want to own the SPX, so I can do a put on the SPX. Now I'll bring in $460, but look how much money I have to put up.
What? Where's the comma?
$126,000.
Oh no. Mm-mm.
I don't have that kind of money in my account to make 460.
Yeah. Yeah.
Now, this max loss, I'm not worrying about that because that assumes that the SPX goes to zero. If the SPX goes to zero, that means the market goes to zero. And if the market goes to zero, we all got worse problems.
More
Everything
problem.
crashed. I
Yeah.
don't care if it's the stock market, real estate, the world has just come to an end. So I'm not worrying about the max loss.
Exactly.
Okay, but I got to still put up $126,000, $127,000 just to bring
Mm-mm.
home 460 in one
No,
day.
no, no, thank you.
That's not very efficient. So that's why I got to do these credit spreads.
God.
So I'd rather collect $145, right? But again, I got to put up almost $1,900 of risk.
Mm-hmm.
So isn't it better to close out at half that, which is about what, $80? Keep 80 rather than risking losing $1,800, $1,900?
Definitely.
So I'm not going to be greedy. If I get half my profit at around half, 40, 50%, hell, I've even done it at 20, 30%.
Mm.
But I'll see if I can get even more, but I don't try to go for the full amount.
Gotcha.
So I'll put this trade on around 330, 345.
Hmm.
And then I'll take the trade off tomorrow morning, like around no later than 10:30, ideally in the morning.
Okay. Gotcha.
So that's how that works. But so we have less than a minute, so we're about to shut off here. But I just wanted to show you. So this is something that you should be doing as credit spreads in your account.
Right. Yeah,
But
thank
I would tell you to use a virtual account though. So you have to find out how to do the virtual side and then practice doing this trade
right. So learn how it goes.
to learn how it goes. And then once you get comfortable, you can use real dollars.
Right. Thank you, Jermaine. I mean, I just wasn't I've heard the words, but I never really understood how it worked. Like I've heard
Right.
people talk about spreads and stuff like that, but thank you for taking the time to break
No
it
problem. This is your first lesson. So,
down. All right, thank you.
okay, we'll talk later.
All right, take care.
Bye bye.
Bye.